Here is a number that should make every European saver sit up. To fund itself this year, the French state needs to borrow around 124 billion euros, and its total public debt has now climbed past 118% of its entire economic output. For decades, France was seen as the steady heart of the Eurozone, sitting calmly beside Germany. In June 2026, that reputation is under serious strain. So what exactly is happening to France's finances right now? Why are investors watching so nervously? And how far could the shockwaves travel across the rest of Europe? Over the next few minutes, we will walk through the real figures, strip out the noise, and explain why France's struggle is fast becoming Europe's problem. Let us start with the core issue, debt. After reaching 115.6% of GDP in 2025, France's government debt ratio is projected to rise to 118.1% in 2026. And forecasts suggest it will push beyond 120% in 2027. To put that in perspective, the European Union's own rulebook sets a reference limit of just 60%. France is now running at roughly double that level. The worry is not only the size of the debt, but its direction of travel. The increase is being driven by large primary deficits and rising interest payments, which are cancelling out any benefit France would normally get from economic growth, slowly shrinking the burden. In short, the country is borrowing more simply to stand still. The second piece of the puzzle is the deficit, the yearly gap between what the government spends and what it raises. For 2026, France's general government deficit is expected to sit at around 5.1% of GDP. Again, that is well above the EU's 3% guideline. Officials have so far insisted on keeping a 5% target, but getting there has been brutally difficult. France continues to run a primary deficit, projected at around 3.4% on average between 2026 and 2030, which makes stabilizing the debt extremely hard. Much of this comes down to politics. A fragmented parliament and repeated deadlock have made it painfully slow to agree on spending cuts or tax rises, leaving the 2026 budget a hard-fought compromise rather than a decisive plan for repair. A struggling budget would be easier to manage if the economy were booming. It is not. French economic activity grew by just 0.8% in 2025, and it is expected to grow at the same modest 0.8% in 2026, weighed down by an energy shock. That leaves France trailing the Eurozone average. At the same time, prices are climbing again. Headline inflation in France is forecast to peak at around 2.9% in the third quarter of 2026 before gradually easing back towards 1.4% by the end of 2027. This combination, weak growth alongside renewed inflation, is the most uncomfortable mix for any government. It squeezes household budgets while limiting the tax revenue the state desperately needs to close its deficit. So how are investors reacting? The clearest signal comes from the bond market. The key measure here is the spread between French 10-year bonds, known as OATs, and their German equivalent, the Bund. As of April 2026, that spread sat at around 70 basis points. Now, that is far below the panic levels of the past. During the European sovereign debt crisis, the same spread hit a terrifying 225 basis points back on the 17th of November, 2011. So this is not a systemic meltdown. But here is the catch: before 2024, that spread regularly sat at just 50 to 55 basis points. The fact that it now rests structurally higher tells us investors are demanding a permanently larger risk premium to lend to France. The market has quietly downgraded its confidence. Now add a fresh complication from the center of European finance. On the 11th of June, 2026, the European Central Bank raised its three key interest rates by 25 basis points, effective from the 17th of June. The deposit rate moved to 2.25%, the main refinancing rate to 2.4%, and the marginal lending rate to 2.65%. Crucially, this was the first rate increase since 2023. The trigger was rising energy costs and inflation risks linked to conflict in the Middle East and disruption to oil shipments through the Strait of Hormuz. The ECB now expects Eurozone inflation of around 3% in 2026. For France, higher rates are doubly painful, because they directly increase the cost of servicing that enormous pile of debt. This is where France stops being a national story and becomes a continental one. France is the Eurozone's second largest economy, so its trouble cannot be quarantined. When French bond spreads widen, nervousness tends to spill over into other heavily indebted members, and Europe's bond markets have already seen bouts of selling pressure. Stalled reforms and uncertainty also drag on confidence and growth across the bloc, at a time when the ECB has trimmed its Eurozone GDP forecast to just 0.8% for 2026. Analysts are watching whether the ECB might eventually deploy its transmission protection instrument, a tool created in 2022 that allows it to buy the bonds of countries facing what it judges to be unjustified market stress. The very fact that this tool is being discussed shows how seriously the risk is taken. So where does this leave us? The honest answer is that France is not in crisis, but it is undeniably fragile. Debt above 118% of GDP, a deficit near 5%, growth stuck at 0.8%, and a central bank now raising rates rather than cutting them. None of these on their own would topple Europe. Together, and combined with political gridlock, they create a slow-burning vulnerability at the very core of the Eurozone. The key things to watch in the months ahead are simple. Does the OAT-Bund spread stay calm or widen? Can France's parliament actually deliver credible savings? And does the ECB hold its nerve? France's finances are still manageable today, but the margin for error has rarely been thinner. If you found this breakdown useful, keep following along, because this story is far from over.